Imagine if you could invest in a pool of car loans just like a bank does and make money out of it. Sounds interesting, right? Hey there, I'm Yash Roongta, the founder of AltXtra, India's first and largest community on alternative investments. And I welcome you to AltXtra series powered by Grip Invest. With AltXtra, we are decoding the complexities of high-yield investments to help you make smarter investment choices. In today's video, we are diving deep into securitized debt instruments, also called SDIs, the star product by Grip Invest, gaining traction fast in India. This video is a bit longer than the previous ones, but if you stick around, by the end of this video, you'll understand what SDIs are, how do they work, and why they can be a good addition to your investment portfolio. So, let's start with the basics. What are SDIs? Securitized debt instruments are financial products where banks and NBFCs bundle various loans together into a single package and sell this package to retail investors for as low as 1 lakh rupees. Think of it as a mutual fund, but instead of stocks, you are investing in different loans like a car loan or a home loan or a gold loan, a pool of them together. To be clear, ये लोन आप नहीं ले रहे हो, आप pool of loans में invest कर रहे हो, जैसे एक बैंक करता है. Let me give you a real life example to even understand this better. I recently took a car loan from a small cooperative bank based out of Mumbai. This loan was at 10.5% XIRR or 8% interest rate. Because I had a positive experience with the bank, I recommended my father and father-in-law to also take out loans from the same bank for the cars they were purchasing. Now, the bank is confident in its credit assessment and wants to grow its car loan book even further. They can raise this money via savings accounts, fixed deposits, or even issue bonds. But they have one more unique way to raise this capital. That is, why not sell the loan book to investors via SDIs? Well, before we get into how SDIs really work, let's understand the parties involved in the process and visualize this through a workflow. First party is someone called as an obligor. Obligor is a person or entity that is taking the loan or financing. Example, my friend Rahul is an obligor if he takes a car loan from a bank. Originator. Originator is an NBFC or bank giving the loan to Rahul or the obligor. For example, Big Brother Bank is the originator which gave the loan to Rahul. Third is the arranger, which is a platform like Grip Invest that securitizes that loan book and oversees the creation of SDIs. Fourth is the SPV or a special purpose vehicle. It's an isolated entity created which houses all the loans issued to people like Rahul. This entity does not get impacted even if the small cooperative bank defaults. Fifth is a trustee, which is a SEBI regulated third party entity which takes care of the SPV, keeping in mind the best interest of investors. They ensure the smooth running of the SPV. Sixth is the servicer. It's an entity that manages the loan in the securitized pool. They are involved in collecting payments, managing non-payments, and transferring the EMI payments coming from borrowers to the SPV. The servicer can generally be the small cooperative bank who issued the loan, or an arranger like Grip Invest, or a third party altogether. Seventh is the credit rating agency, which is again a regulated third party entity like a ICRA or a CRISIL doing independent risk assessment of the underlying pool of loans and providing a rating. 8 are your regulators, which is SEBI and RBI, issuing guidelines on how the instrument should be structured and sold to retail investors. 9th are the exchanges, which is NSE or BSE, facilitating the trade of SDIs via them. 10th are the investors, which is finally you, who will buy the securities or SDIs that will be issued by the special purpose vehicle. I hope all these points or all these parties involved in the SDI process were very clear to you. Let's understand this further step by step by taking my car loan, which I earlier talked about, as an example. Step 1. The small cooperative bank has given out a car loan to me, my father and father-in-law for our respective car purchases. They have given out similar loans to hundreds of other individuals as well. Step 2. An arranger like Grip Invest would work with the cooperative bank and cherry pick individual loans to create a package which is favorable to both the entities. This methodology of cherry picking is unique to each arranger and created based on the preferences of retail investors like you and me. Step 3. Once the pool of loans has been finalized, those assets will be transferred to the special purpose vehicle. Let's call it India Car Mobility Trust 1. This SPV will be created and maintained by Grip Invest. The cooperative bank will also post some collateral to the SPV to protect the retail investor in case of defaults. This collateral can be in the form of cash, physical assets, personal guarantees, and many others. Step 4. Grip Invest would assign an independent SEBI registered trustee who would oversee the pool of loans within the SPV with the best interest of investors in mind. Step 5. Grip would assign a regulated credit rating agency to assign the pool of loans a fair rating. Grip would also then get the security listed on the exchange if required. Step 6. The SDI, which comprises of a pool of loan, would then be sold to the retail investors via the Grip platform. As money is received by Grip, it is passed on to the SPV and ultimately to the cooperative bank that can use that fresh money to give out more car loans. Step 7. All interest plus principal repayment on the loans which me and my family make and along with other individuals are paid to the servicer, which can again be same as the cooperative bank, Grip, or someone else altogether. These EMIs would then be passed on to the SPV and money is then paid out to the retail investors who bought the SDI. All these operations are overseen by an independent trustee. Well, hopefully that gave you a fair idea of how SDIs work. If not, screenshot this workflow, and if you have any questions within this workflow, please reach out to Grip's team or my team and we'll be happy to help and assist. In India, Grip Invest offers SDI options like Invoice X, Loan X, Lease X, and Bond X. Each of them cater to different types of loans or leases, offering diversified investment options to retail investors. SDIs, as you might already know by now, are listed, rated, and regulated instruments offering diversified exposure and have excellent safeguards like over-collateralization and excess interest spread. To be transparent, there are some downsides to SDI as well. The very first one being they're a bit complex to understand. The second one being they face higher TDS deductions when compared to corporate bonds. Third one being there is very limited liquidity in the Indian market for SDIs. Well, to summarize, SDIs convert various types of loans into tradable securities, offering diversification and potentially higher returns. While they come with risks and complexities, Their structured safeguards and regulatory frameworks make them a compelling choice for informed investors. SDIs will play a key role in recycling credit within the Indian economy, which will ultimately fuel its growth. That's it for today. Thank you so much for watching. What do you think about SDIs? Are they something you would consider adding to your portfolio? Let us know in comments below. And stay tuned for more insights from AltXtra, powered by Alt Investor and Grip Invest. And don't forget to like and share this video and subscribe to the channel. Thank you so much. Happy investing.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and or default in payment. Read all the offer related documents carefully.